You mentioned the new timeline sort of articulated by Chairman Bernanke last week. Now, as you know, markets have moved quite a bit. Mortgage rates have come up. Longer-term rates have come up. I'm wondering, at what point do these tighter financial conditions, undercut the investing and spending and growth that you're trying to achieve here?
Well, there's no question that tighter financial conditions will have some impact on the growth rate, but it depends in part why are bond yields moving up. If bond yields are moving up because people are becoming more confident about the economic outlook, it would probably be incorrect to then say, well, we have to mark down our economic forecast because bond yields have moved up. So we'll definitely be taking into account the state of financial conditions, but probably much more important than that is what the economic data actually reveals about how this tug of war between fiscal policy and improving fundamentals gets resolved. That's really the key. So it's really the economic news that I think is going to be more important than financial market developments, recognizing that financial market developments do have an impact on the economy.
Benjamin?
You referenced the possibility that investors have misunderstood your remarks last week, or the chairman's remarks last week about the timing of any increase in interest rates. Some investors say they understand perfectly what was said. They don't trust you. They think you've pulled back more quickly on asset purchases than they expected, and they're concerned that you'll end up doing the same thing with interest rates. Are there ways in which the Fed could seek to reassure investors? Is that a concern for you that you've lost credibility with markets?
Well, I can't judge whether we've lost credibility or not. I think what we're trying to do is be as clear in our communications as possible. And if you listen carefully to the chairman's press conference, I think he was very clear about laying out a potential path under a particular set of scenarios, recognizing that the scenario could be quite different. And I think if you actually look at the path that he laid out, it really wasn't meaningfully different than what market participants had actually said that they were expecting. There was a Bloomberg poll that came out prior to the chairman's press conference, and it basically showed that the market expectation was that the Fed, if things evolved in a way that the market consensus expected, that the Fed would likely dial down asset purchases sometime in either September or December sort of time frame. And so I think what he said was fully consistent with those market expectations.
Steve?
Bill, I actually have two questions. You can only answer one if that's what you feel like. It's fine. Steve Leisman, CNBC. Bill, what went wrong here? You guys made a statement and the market reacted in a way that you clearly did not want and seemed to walk away with an understanding that was different from what you guys intended. Does what happened here hurt the ability of the Fed to communicate future policy? That's the first question I have, is really what went wrong in your opinion and how can that be corrected? The second one is, how much concern do you have about the change in interest rate yields and the effect it could have on balance sheets, bank balance sheets?
So first of all, I guess I don't really accept the premise that something horribly went wrong. I think markets are always very difficult to evaluate in terms of what's priced in, what positions are in the market, how secure those positions are, how easy it is to disturb those positions and precipitate a abrupt exit. So I think saying that we know exactly where markets are and exactly how they're going to behave under any set of circumstances, I think that's just not the case. I mean, J.P. Morgan many years ago was questioned on the street corner by someone who was asked about, so what do you think the stock market's going to do? And his answer was, I think the right answer is, he said, quote, "It will fluctuate." John Maynard Keynes was asked about how do you value markets, and he said, really, in his view, it's a beauty contest. It's not like there's a fundamental value for the markets. It's really what investors think that other investors will actually pay for assets. So I think that it's important not to over invest in what the markets have done. I think you're right that as Jonathan raised as well, obviously financial conditions do matter for the economic outlook, and so we'll take that into consideration. But the news subsequent in terms of the economic news is what really is really important. All that we can do is try to be as clear as possible in terms of our communications. And I think that, to be really fair to the chairman, I think he was very clear about how we would likely behave under a particular set of circumstances. It's perhaps possible that the market overweighted, the likelihood of that particular set of circumstances because life is highly uncertain. Also, I think that it's very important to recognize that the chairman wasn't really, in my mind, this is my opinion, I don't think the chairman was trying to send any signal to the market. I think the chairman was just trying to elucidate with a little bit more clarity how the Federal Reserve would likely behave in terms of asset purchases if the economy evolved along a certain trajectory. So it's trying to provide greater clarity. I think some market participants took that as some sort of a hint or signal, and I don't think that was meant at all. I think we're trying to communicate plain speaking in a very transparent style. That people misinterpret that as us trying to send hints. I just think that's not what we're trying to do. We're trying to be very open and plain speaking as possible.
Please.
Hi, I'm Matthew Walter with the Wall Street Journal. I just was curious if, given that, I guess, the confusion that we had, do you think it would make sense to try to introduce some sort of threshold for the bond purchasing program, similar to the thresholds that have been introduced for the short-term rates?
Well, I think that in some ways the chairman has introduced a very soft notion of what might be the point at which the labor market might be when we might actually end the asset purchases. He said that if the economy were to evolve along the lines of the central tendency forecast, that he would expect that the asset purchases would be wound down around the middle of 2014. And he noted under the SEP Summary of Economic Projections forecast that the unemployment rate would be around, in his mind, around 7% at the time. So that's not a formal threshold. And I think the reason why we don't really want to have a formal threshold is that it does matter why the unemployment rate is declining, number one. So if the unemployment rate is declining because a lot of people are discouraged workers and they've dropped out of the labor force, but they're subsequently likely to come back in as the labor market improves, then you wouldn't want to overweight a decline in the unemployment rate to 7%. Also, it's important not just what the unemployment rate is, but this is if you look at what the Fed has said what we said in our statement, it's about substantial improvement in the labor market outlook. So it's not just what the labor market has done, it's what the outlook for the labor market is. And so the growth momentum of the economy is also relevant here. So if you were at a 7% unemployment rate and the economy was dead in the water, you'd have a very different interpretation of the appropriate policy than if the unemployment rate was at 7% and you actually saw that the economy was growing fast and you expect it to continue to grow fastly going forward. So I think, the unemployment rate, I think, is too narrow a summary statistic to sort of really describe how an asset purchase program would work. He was just trying to give some illustrative guidance about, what a reasonable expectation might be if the central tendency scenario were to actually play out.
Thank you. Josh?
Josh Newman from Bloomberg. In your speech here, you outlined the view that as long as the balance sheet is still growing, it's still accommodation, and this is kind of predicated on the stock argument over the flow argument. But a lot of people in the markets, it's not that they just don't see it that way. They say you were buying $85 billion a month. If you cut to $60 billion a month, that's less stimulus. And we've had a little bit of an event study here where the chairman said we might not end purchases until mid-2014, which is a little bit longer than the markets had expected. So the stock is maybe a little bit higher. But they were reacting to the flow going down sooner. Is it possible that the Fed is wrong, that the stock effect predominates the flow effect? Does that mean you'd be tightening sooner, and would that have to force you to rethink policy?
Stock versus flow. Could we be wrong? Of course, could we be wrong? We're not infallible. I think that the conclusion that stock effects dominate over flow effects is because we've actually run a number of experiments essentially over the last few years. So, for example, when the first large asset purchase ended, we ended the program, and the end of the program did not lead to any sort of big backup in yields that one might expect if the flow effect were to dominate. The same is the case with the large-scale asset purchase number 2. So, in the past, when we've ended these programs, there was no evidence that the turning down the flow or turning off the flow led to a significant backup in rates. So that seemed to argue against the flow effect. Also, if I can just give you a little thought experiment. So let's imagine that the Fed said we're going to buy a tremendous amount of securities over the next 6 months, and then we're going to sell those securities over the subsequent 6 months. Would you think the flow there would be really the driving force of the market? I think the market would say that, oh, that's not really much of a, that doesn't really do anything to the economy if you're just going to buy them and sell them right back. So I'm you know, the jury is still out, you know, exactly on how to weight precisely how much you would weight on stocks versus flow, but I think the evidence accumulated over the last 4 years argues that the stock effects seem to be by significantly more powerful.
Annalyn Kurtz with CNN Money. I was hoping you could talk about your outlook for the housing market. Has it changed at all in the last few weeks? Do you expect rising rates to sap any of the momentum that we've had in the housing recovery?
I mean, we'll see what happens to the housing sector going forward, but I think the fundamental supports for housing are actually very strong right now. I think you have growth in employment, which leads to increases in household formation, which creates underlying demand for houses. I think you have improved credit availability into the mortgage sector. I think you have mortgage rates that are still very low on a historical basis, and if you look at the decision about whether to purchase or to rent, housing still looks very affordable on a purchase basis as opposed to a rental basis if you look at it nationally. Now, obviously, it varies region to region. So it seems to me that the fundamental supports for housing are still very, very strong.
Very good. Rick?
Rick Newman with Yahoo Finance. Do you think leading up to the last couple of weeks, investors and bond investors simply became too complacent? Maybe there was too much leverage in the bond market, for example?
I don't want to speculate exactly what was going on in the market, except to say that, markets, the ability to sort of understand exactly how people are positioned, what their expectations are, what their staying power is in response to, news that they view as negative vis-a-vis their positions, always really difficult to assess. And that's probably why J.P. Morgan said the markets will fluctuate.
In the back, I'm sorry. I can't see you, but please.
Bill Watts with MarketWatch. Just when it comes to the inflation target, it seems maybe there's some skepticism that the Fed is willing to be as aggressive defending the target on the downside as it is on the upside. Do you think that is a concern, and what do you make of that?
I mean, I can only speak for myself. I look at the target as very much, symmetric. I mean, we want to hit the target on, we don't want to miss on either side. Our target is 2%. I think that, today inflation is, below our target. I mean, we're running about 1%, and our target for the PCE deflator is about 2%. But what's different than, say, for example, in 2010, is it looks like some of the causes of this low inflation are causes that look to be transitory. So that argues for inflation drifting back up. And two, unlike in the fall of 2010, inflation expectations still look quite well anchored. And so inflation expectations are above the actual rate of inflation. And so that we would expect that will actually pull inflation up as we go forward. Now, obviously, we're going to continue to monitor this, and it's certainly possible that if the inflation news were to come out in a particular way, this could raise to a higher degree of concern on our part. For example, for me, if I saw inflation expectations come down meaningfully further, there's been about a 30 basis point decline over the last few months. If inflation expectations, what you measured by the 5x5 tips forward inflation rate expectations, if that came down significantly further, then I would actually get more concerned about the future inflation outlook.
I think we'll take one or two more questions on this topic before shifting back. Binya?
You said it matters why the unemployment rate is declining, yet the chairman last week said that a decline from 8.1% to 7% would be a substantial improvement in his mind, without referencing that content. So far, the declines have come entirely because people are leaving the workforce. How concerned are you that that will continue, and why is that not more explicitly a part of the metrics you're applying to policy?
I think it's probably too strong to say that the declines in the unemployment rate are completely due to people, the decline in participation rates. I mean, if you look at the payroll employment figures over the last 6 months, we're rising, they're rising at roughly 200,000 per month. So we've actually had pretty substantial gains in payroll employment. I'm not going to speculate exactly, what was in, the chairman's mind when he made those remarks. I can just speak for myself. I mean, I think the unemployment rate's a summary statistic, but it's not a complete summary statistic. And so why it's at 7% is relevant to us. And what the growth momentum of the economy is at the time is also very relevant. Because remember, the metric in terms of the asset purchases is, as I said before, substantial improvement in the labor market outlook. So it's looking forward. And so I think that's important.
Last question on this. Steve.
Bill, could you discuss the change in interest rates and the effect it might have had on bank balance sheets, and is it a source of concern for financial stability?
Obviously, one thing that we think very hard about is the risk to financial stability from any source, including our own monetary policies. And, we certainly have looked at the banks' exposure in terms of the risk of what would happen to the banking sector if there was a sharp increase in interest rates. And, the analysis that I'm aware of suggests that the consequences for the banking system from the kind of backup in rates that we've seen, not a problem. Two things happen when there's a backup in longer-term rates. On one hand, there's some losses on a mark-to-market basis on existing assets. But two, and this is important, the new assets that are booked come on with a higher yield, and that actually supports the net interest margin. So it's sort of a there's sort of a positive and a negative. And so this is not something that I, at this stage, would be concerned about. But obviously, we need to look at this on an ongoing basis.
Very good. Good time to shift back to the topics of the day. I'm going to take a couple of questions that came to us from via the web. The first question, I think, would be for Richard. So in areas with higher unemployment rates, is underemployment for college grads less of an issue?
I don't think we're sort of saying that it's less of an issue. There are, I think, when we looked across majors, we did see that some of the fields that tended to have better outcomes in terms of lower unemployment also tended to have lower underemployment. I don't think we see much evidence that there's a trade-off between the two.
Very good. The next question is for President Dudley. Comes from Shaheen Nasrapur from the Huffington Post. And I quote, Mr. Dudley, you mentioned the dramatic increase in student debt. Yesterday, Rohit Chopra of the Consumer Financial Protection Bureau opined that inefficiencies in the student debt market are blunting the effects of accommodative monetary policy, preventing borrowers with student debt from benefiting from the Fed's efforts to reduce borrowing costs. Do you agree with Mr. Chopra? What can the Fed do to help borrowers refinance their high-rate student debt?
I'm going to take the first part of that question. I think there's no question that the increase in student debt burdens does have a consequence for people who are just entering the labor market. It does lead to delay in terms of their ability to buy consumer durables and buy houses, and so that does actually have an implication for the economy and the economic recovery. So, we've done a lot of work here at the New York Fed trying to develop data to describe the student debt problem. We think that this is an issue that does deserve serious attention because it does have consequences not just for the macroeconomy but also for all the people that are struggling with these high debt burdens.
And the second part of the question, what can the Fed do to help borrowers refinance their student debt?
I think the issue of the student loan refinancing issue would be an issue left to Congress, not to the Fed. This is steering into fiscal policy, not monetary policy. I think this is really out of the Fed's purview.
Thank you. Any questions? Yes, Rick.
I was surprised to see on this chart that shows U.S. of the underemployment rate by. Sorry. On this chart showing the underemployment rate for recent graduates, it's surprising that it was actually considerably higher in the early and mid-'90s, and then it came, you mentioned why it came down, but why was it so high then, higher than it is now? And is there anything to learn from the decline in that underemployment rate that's useful to this current situation?
So, I mean, part of the reason it was high during that period is we did have a recession prior to when those numbers spiked up to over 45%. But this number tended to be higher before the tech boom and before the long expansion of the 1990s. So I think what we learned is that during the 1990s there was a big movement that absorbed a lot of recent college graduates into the labor market. There was a high demand for college graduates as the economy was shifting and changing, and that to some extent, that same force is not at work with that same momentum in terms of change over the 2000s, and that things appear to be a little different. And having two recessions in the 2000s probably also, with jobs recovery, has probably also affected that.
Can you make the case that the technology economy hasn't, because I don't know what the numbers are before this, but that the technology economy has sort of brought down the average underemployment rate for this group?
I think it's safe to say that, coupled with a strong business cycle and what was going on, what was driving it, the technology, which is geared toward analytic thinking, cognitive skills, which also is complementary to college education, did have that kind of an effect. Whether that will continue is harder to know, but it certainly seems like historically that was the case.
Speaking for myself, I think younger people have a comparative advantage in technology.
Any other questions? Yes, please.
Just a question about the underemployment, and just wondering if you factor in those college graduates who have started their own businesses and what the statistics around that is like.
Yeah, that is not something that we were able to sort of isolate and look. We're looking at people who really, they just tell us what their job is. So we're not able to identify whether that means they've got their own business and sort of how that dynamic may have changed and what that looks like for recent college graduates.
Can I just say something more? There's one sort of interesting problem that we have here is that the labor market dynamics have changed in a pretty significant way, especially for younger workers. We have a director on our board of directors, Sarah Horowitz, who's the head of the Freelancers Union, and she points out to us, that the idea of steady employment with one employer for younger people is actually not always the case, that it's, as she likes to put it, it's a series of gigs that people engage in. And so we actually have a sort of interesting problem that the way we collect the labor market statistics don't really match up with this sort of change in the structure of the labor market. And so this is something that we're looking at to see if there's a way to try to improve the labor market statistics to capture the changes in the nature of what sort of employment is.
Josh?
I wanted to ask about the chart that shows the unemployment rates for recent graduates, all college graduates, and the working age population. It appears that the recent graduates just sort of split the difference between the working age population and the college graduates. Does that suggest that this weakness for recent graduates is almost entirely a cyclical phenomenon that will recede once the economy is stronger?
There definitely appears to be a strong cyclical component. Whether that's the only thing that's going on is not clear. So certainly, because of the weak job market, especially after this last recession, absorbing recent college graduates has been certainly a lot more difficult than it has been in the past. But as the labor market has been improving, we've seen that unemployment rate come down for recent college graduates, fairly significantly. The question also, I think, inherent in what you're asking is whether this is all sort of a cyclical component or whether, I think, going back to an earlier question, some of this may be differences in the structure of the labor market that's sort of pushing this unemployment rate a little bit higher on a permanent basis. And I think we're not quite clear on that, especially because the cyclical component has been so strong over the past several years.
I think it's fair to say, Richard, isn't it, that this is sort of what your probably working hypothesis would be, but whether that working hypothesis turns out to be correct, we're going to have to see how the recovery unfolds and what actually happens to the unemployment in this area. But I think you draw the right inferences as far as what's a reasonable working hypothesis.
Any other questions? No? Well, thank you all very much for coming. Our economists will be here to answer any additional questions you may have on today's topics. We ask that those filming, recording, please stop doing so at this time. And again, thank you very much for coming, and we're available to answer follow-up questions. Thank you.